What if the world's most powerful financial institutions were hiding secrets that cost billions? From shadow networks to mishandled fortunes, the negligence runs deeper than anyone imagined. What is the dark, unspoken truth about wealth management and private banking operational risk management? Beyond the pristine spreadsheets and the promises of generational wealth, what is really happening behind the vault doors of the world's most elite financial institutions? The shocking truth is that the greatest threat to generational wealth isn't a sudden market crash or a volatile geopolitical event. It is a silent, internal crisis, costing billions of dollars, born from the very foundation of trust that these prestigious institutions rely upon to exist.
What exactly is operational risk management in this highly exclusive, ultra-wealthy sector of the global economy? How does it differ from traditional banking security? Operational risk management is the banking world's internal immune system. It is designed to prevent devastating losses from inadequate internal processes, system failures, or human error. But in private banking, the primary risk isn't a computer glitch. It is the highly paid, charismatic humans managing the money. Without physical bank heists, how much financial devastation can a single elite banker realistically cause from behind a mahogany desk?
The financial damage can be absolutely astronomical. Consider Credit Suisse, which was recently ordered to pay a staggering $926 million. The root cause was a single rogue rainmaker who systematically forged client signatures to desperately hide mounting trading losses from his superiors. How do these rogue bankers consistently evade detection from internal security and compliance officers for years at a time?
They weaponize intimacy. Private banking is fundamentally built on deep personal relationships. Relationship managers exploit this profound client trust to bypass standard corporate controls, smoothly convincing clients to sign blank documents or approve complex, high-risk products without ever asking any difficult questions.
Don't modern financial institutions have strict automated access controls to prevent unauthorized multi-million-dollar fund transfers?
On paper, yes, but in practice, external auditors frequently discover a terrifying reality. Star relationship managers often retain legacy, godlike system access. This unchecked digital power allows them to independently authorize massive, unverified fund transfers without the mandatory secondary approvals from compliance officers.
What happens to this delicate, high-stakes balance of trust when a wealth management firm is suddenly bought out by new ownership?
The results are mathematically catastrophic. When private equity firms acquire a wealth management practice, the pressure to maximize aggressive returns skyrockets overnight. Shockingly, financial advisor misconduct spikes by a staggering 147% immediately following these high-stakes corporate buyouts.
How are these bad actors successfully hiding their illicit activities and high-pressure sales tactics from modern multi-million-dollar corporate surveillance systems? They retreat to the dark corners of our smartphones. The number one blind spot for modern bank auditors is the informal, encrypted banter happening on apps like WhatsApp. Relationship managers use these hidden, off-channel communications to bypass corporate surveillance and orchestrate highly unsanctioned, lucrative deals. Exactly how much is this shadow communication network costing Wall Street's biggest, most prestigious financial players? Over 100 financial firms have been caught and penalized, with U.S. regulators levying over $2.5 billion in fines since 2021. J.P. Morgan alone faced a landmark $125 million penalty simply for failing to monitor these off-channel communications. Is it just rogue digital messages? Or is the actual, highly confidential data of the world's wealthiest individuals physically at risk?
The negligence extends to physical hardware. In a stunning oversight, Morgan Stanley was fined $60 million after unencrypted servers packed with elite, ultra-wealthy client data were accidentally sold to a local hardware recycler. It was a catastrophic failure of basic vendor management protocols.
How did banks traditionally defend themselves in court when a wealthy client lost everything due to gross misconduct or negligence? They relied on the ultimate legal weapon, the paper shield. For decades, if a client lost millions on a toxic investment, the bank's legal team would simply produce a heavily jargoned suitability document,
pointing to the client's own signature as ironclad proof of informed consent.
Does a client's signature still protect a private bank from severe regulatory wrath and multi-million-dollar lawsuits today?
Not anymore. The paper shield is completely dead. Modern regulations, like the FCA's Consumer Duty, now require firms to proactively prove they delivered good outcomes. UBS Puerto Rico learned this the hard way, paying $41 million after a broker missold proprietary closed-end mutual funds.
With traditional defenses failing, how are modern banks attempting to control their increasingly autonomous and powerful relationship managers? They are unleashing artificial intelligence. Banks are desperately turning to AI surveillance, deploying advanced algorithms to scan millions of emails, complex trades, and behavioral patterns in real time. They are desperately hoping to catch the subtle, digital anomalies that precede a catastrophic financial crime. Can artificial intelligence actually catch a rogue banker and stop a massive financial fraud before the damage is permanently done?
AI can flag unusual trading volumes or keyword anomalies, but it fundamentally struggles with human nuance. It cannot measure the dangerous intimacy of a handshake deal or the quiet, emotional manipulation of an elderly client. Algorithms cannot easily fix a fundamentally human problem.
What actually happens to an elite financial advisor when they are finally caught by the system and fired for outright fraud?
You would assume they are permanently banished from Wall Street in disgrace. But the reality is a revolving door of elite misconduct. When a high-producing advisor is terminated for breaking the rules, they simply pack up their lucrative client list and move down the street.